Welcome, everyone, to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options, not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to exit your highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Swarts. In each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspiration so together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on Expert CRE Secrets, Capital Gains Tax Solutions YouTube channel, the Kingdom Luxury Realty YouTube channel, and our Facebook channels. And I'm your co-host, Pearson York, and I'm filling in for Brett Swarts today. And today, our next guest has been in the financial space for the last 30 years, really helping in the educational world of self-directed. And we're going to learn a ton from him. So, John Paul, how you doing?
Hey, how you doing, man?
Awesome. So, how did you get into financial advising?
Well, I'm actually not in the financial advising world, but I do train financial advisors. I worked my way up from the trade desk all the way up to being a relationship manager with over 7 investment organizations, 5 of them mutual fund companies, 2 are insurance companies. But one of the things that I fell in love with is the fact that as I talk to people, it does help their long-term financial goals when it comes to saving up for retirement, right? What is retirement? It's having enough money we can wake up in the morning and say, I don't have to go to work, right? So, and tax deferment is one of those biggest, I believe, gifts from the U.S. tax code that allows for us to be able to grow wealth. Imagine your earnings in your investments are not going to get taxed until you take it out. And even in some investments, it has the same tax deferred feature, but eventually when you take that distribution, it's going to be tax free, right? It's a little bit different than your regular retirement plans that when every time money comes out, you know, the IRS on the background say, come to Jesus, you know what I mean? But on a retirement plan, you have choices, but it all grows tax deferred. So it exponentially allows for your investments to grow faster. Yeah.
So let me ask you this, so when you have self-directed, and you want to grow your wealth,
yep,
basically tax deferred, but then you're taxed when it comes out. It almost seems like it's more advantageous for the government to do that because you're growing more, and then as you've grown, right, you're going to get taxed more on the back end because you've increased your brackets and all that kind of stuff. It's almost like getting taxed on the harvest and not the seeds. So can you speak to that a little bit?
Yes. Well, that's why okay. To speak on your point first, right? There's over $38 trillion in retirement plans today, or over $14 trillion in IRAs, and steadily increasing. Why is that? Because a lot of people bank their money away in employer-sponsored plans, like your 401k plans, your SEP plans, simplified employee pension plans, simple plans, 403b plans, governmental 457b plans. Anytime you have a workspace environment that has an employer-sponsored plan, it allows for you to postpone or defer the taxation that you have. That's why the government likes it. Why? Because number one, Social Security is pretty strained right now. Eventually, they were really trying to mitigate risk or mitigate the amount of damage that's going to happen with the 78 million, what we call baby boomers, born between 1946 and 64. A little bit of history on that. That's why they passed a law called ERISA that actually snowballed a lot of these retirement plans that we're experiencing today. But it's eventually they knew that they were going to be taxing these dollars. As a matter of fact, right now, last year, Richard Neals, the head of the Health Committee, Health, Education, Labor, and Pensions, was trying to introduce some laws that could actually speed up the process of getting this money out. It's like what you're saying. Getting this money out means it produces taxation because they know that there's $38 trillion in there. But we do have a magic pill on that because Senator Roth in 1997, when he passed when the law called the Taxpayer Relief Act of 1997 was passed, it created a brand new account called the Roth IRA, which, as a matter of fact, the Health Committee doesn't like a lot because there's no taxation, right? I mentioned when we were conversing before we started the podcast, that distribution on those assets will eventually be what? Tax free. You know, it's a little bit different. It's exciting, man. Imagine if you had a piece of real estate under your retirement plan, which some of your listeners might not know, that you could actually hold a piece of real estate in your retirement plan. Not only is the rental income not being taxed because it's received by a tax deferred account, eventually, once they've had that particular account for 5 years and they reach age 59 and a half, dead, we don't want that to happen, but it could happen, right? I mean, your beneficiaries would be enjoying that. That's why I volunteer myself to be a beneficiary of a Roth. And last but not least, that was a joke. And last but not least, if they become disabled, you know, some people, as they get older, their health starts to dwindle down. Imagine if you become disabled prior to reaching age 59 and a half. Wouldn't you like all your retirement plan assets to be distributed tax-free?
Yeah,
that's
absolutely.
The power of a Roth. So in other words, so those are the types of conversations and kind of questions, you know, like brave conversations people need to ask themselves. Is this thing called a tax deferred account still working for me? Absolutely, because it reduces taxation, but eventually you're going to get taxed on it, prolonging your agony. But there's another solution to that, and that's what we call a Roth. With the help of their tax advisors and their legal advisors, they can determine how much to contribute to those, as well as they can even do what we call a conversion. A conversion is not a spiritual experience, but it could be, because they can actually take those assets that have never been taxed before, get taxed on it in the year that they actually put it to the Roth. In other words, they can move that to the Roth. Now, to speak to what you just said about, well, they're going to be in a higher bracket, so on and so on. We don't know what bracket system we're going to be in. As a matter of fact, in November of this year, we're going to have another election. You know what that means? New ideas are coming in, and everything again could change. How would you like it that you had the magic pill that even if they change the tax law, that distributions that are going to be tax-free will never be affected ever again by any changes that they do?
Yes.
That's why that Roth is very important. Out of the 4 different levels of taxation an individual could be subject to when they take money out of an IRA, as an example. And what are those? The federal tax. If you live in a state that has state income tax, in which I do, you know, I used to live in Minnesota as well. I mean, you get taxed up. You know, they have 2 seasons to fund, winter and road construction. So you have federal tax, state tax, and also this other thing called the federal estate tax. People that are high net worth, man, you know, they're starting to dump assets. If you take money out of an account that's never been taxed before, well, can you really truthfully say that you're gifting that amount of money to somebody else? The answer is no, because every time you take money out, you know, it increases the level of your taxation. But imagine if that was in a Roth IRA, that the growth has been growing under the Roth. And eventually, when you say, you know what, I've accumulated so much wealth, which is not a bad problem, I'd like to gift some of that money to my children today. Imagine distributing it tax-free, and it's not going to affect any of your taxation for that year. As well as individuals who are reaching that age where they're collecting what we call Social Security. I don't know if you know this, but Social Security is generally not taxable if your taxable income does not exceed certain thresholds. It's around $36,000 for a married couple filing a joint tax return, and it's around $25,000 to $26,000 for a single filer. If your taxable income does not exceed those particular thresholds, well, your Social Security income is not taxed. Imagine taking $100,000 out of a Roth IRA tax-free. What is that going to do to your Social Security? Actually, it's not going to do anything. In retirement plans as well, when somebody reaches a magical age of 72, they have to start taking what we call minimum distributions. In other words, that's where you were getting at. The government says, I've allowed for you to accumulate all this wealth this whole time. When you reach 72, it's my turn. You're going to have to take a minimum out. And if you don't take that minimum out, you get penalized. It's a 50% penalty. In a Roth IRA, there's no such thing. Imagine you reach 72, you have an apartment complex now at a Roth IRA earning. You keep in mind that rental income coming into the Roth is not going to get taxed. And if you need money to take out for your retirement, well, what is it going to cost you? Absolutely nothing, because it's tax-free. Tax-free for the rest of your life. Not only can you use it for retirement, you can use it for health benefits, because keep in mind the cost of healthcare is going through the roof. I don't know about you, but I'd like to take it out of an account that Uncle Sam does not have to touch it at all, nor the state. Right? So How many levels of taxation have we gotten rid of so far or minimized? 3. I don't know about you. I used to watch Sesame Street 4 is more than One, right? And if you live in a state that basically does not touch what we call people inheriting assets, and just like that's why Florida, Texas, those are very attractive states, to live in. And some of them that I teach at, they say, you know what? You see those mailboxes, they're full of mail, right? But you don't see any people. The reason for that is they're someplace else, but they use those states as their permanent tax filing addresses so that when they pass away, the beneficiaries that receive those assets could minimize the amount of what we call an inheritance tax. Imagine 4 different levels of taxation, reducing that to none. Man, that's powerful.
Yeah, that's an amazing strategy that we can use. And I actually just did a conversion from a 401k that I had with a W-2 job to a self-directed IRA account, and then did a backdoor Roth. And then just because I quit my W-2 job, which was paying me really well.
Yeah.
And then this year I was going to hit, a really low tax bracket or whatever. So I was like, if I convert it now, I can put that whole chunk into a Roth.
That's right.
Self-directed Roth account. And then, so I invested in a friend's Bitcoin mining fund that we had on the show. And whatnot. And I was just like, this is going to be great. And I'm pumped.
Well, even better than that. Let's say some people go, well, all that stuff you're talking about is great. I don't have any money. All right. I only have, I want to buy a $200,000 piece of property. I only have $100,000. So I have to wait till I have $200,000 to be able to buy that $200,000 piece of property. And I say, that's not true. There's what we call unrelated debt finance income. They said, what? What is that? Well, it's been around for a long time. That's how high net worth individuals build their wealth. In other words, in a retirement plan, you can't use your own credit because that's going to be what we call a prohibited transaction. Well, then the IRA has to stand alone and qualify for that loan. That loan is what we call a non-recourse loan. As a matter of fact, I have a list of that on our website, a list of non-recourse loan lenders. A lot of lenders like it. You know why? Because there's a lot more skin in the game that's required. The lowest one that I've found out there, down payment, is 35%. Wow, that's only 15% more of a general loan, conventional loan out there in the retail market. If you have 35% of the value of the house, you mean I can buy that with my IRA? The answer is absolutely. The portion or the percentage that you borrowed will determine the amount of taxation on the level of income. But as you make payments on that loan, what happens to that loan? It becomes smaller and smaller. And eventually, imagine paying off that loan. If you pay off that loan, all of those assets, as a matter of fact, if you did this in a Roth, imagine that would be all tax-free for the rest of your life. That's a powerful statement. Not only tax-free for yourself for the rest of your life, when you pass away, built into law, in other words, built into the code and regulations, your beneficiaries can create a stream of payments, especially, for example, if it's your spouse, based on his or her life expectancy, that can be distributed on a yearly basis, tax-free. How would you like that?
Yeah, I would love that. And so that kind of brings me to this question then. So as an active real estate investor, right, we're buying consistently, right, holding properties and whatnot.
Yes.
Are you saying that we can do all of that in a Roth IRA account? That
you can do it in a Roth IRA. As a matter of fact, a lot of entrepreneurs don't have any employees. In other words, what the IRS calls them one participant or owner only types of plans, right? Entrepreneurs, and they would partner with other people, so on and so forth. Those can actually establish even what we call an individual 401k plan, solo 401k plan. The IRS calls it a one participant plan. They have a website dedicated just for that. Remember that unrelated debt finance income that I'm talking about?
Yeah.
That does not exist in an individual 401k plan. Imagine your 401k plan account borrows money, purchases real estate. The income of that would generally be, a portion of it would be taxable under an IRA. But in a 401k plan, under 514C9, that's a nerd part of me coming out, that's actually in the tax code. 401k plans are exempt from what we call unrelated debt financed income. So a lot of people are using their individual 401k plans to actually do this thing. So the answer to your question is yes.
So they are able to use their 401k plans to get non-recourse loans. And can they operate it as like a business, like paying expenses and stuff out of it as well?
Well, the 401k plan can only be established if an individual has a business. That's why I say entrepreneurs, right? You know, for example, if you just work, you and your spouse buys a piece of real estate, and I'm not talking about rental income. I'm talking about this is your business. You do property development, right? Whatever it may be. The income that you have, a portion, here's another benefit, right? Let's say you make this much. Can you see my hands, right? How would you like it that you contribute to an individual 401k plan? And the maximum, by the way, has two components, one of which is the employee's deferral, similar to the 401k plan you work for, portion being taken out of your paycheck. The maximum this year, by the way, is $20,500. That's a boatload of cash, all right, for some people. In addition to that, depending upon your level of income, you can also make a profit sharing contribution up to 25% of your income, as long as the $20,500 and the profit sharing combined does not exceed this one number, $61,000. In other words, if you get paid enough, not only can you contribute $61,000 to your account, if you have a spouse or a partner, they can also contribute up to $61,000. And above and beyond that, if you're over 50 like myself, although I don't look like I'm 50, at least that's what my kids say, you can put an additional $6,500 called a catch-up contribution. And you know what's going to happen to your level of income? It's going to be reduced because those are all deductible.
Right.
Imagine making this much, reducing your level of income, putting in an account under your own name, and start investing on a tax-deferred basis under your 401k plan.
So then how do you turn around and you get that 401k plan into the Roth IRA?
Well, okay, there's what we call, if it's in the 401k plan, in other words, it has what we call distributable events that allow for you to take money out. Well, then don't take money out. Within the 401k plan, you could have what we call a designated Roth component. This was allowed in 2006 under the Pension Protection Act, because that was the effective date of the Roth component under a tax law called EGTRA. And anyway, you don't have to remember that. In 2006, 401k plans now allowed what we call a designated Roth contribution, which means you could hold a Roth component within your 401k plan. They allowed what we call an in-plan Roth conversion. In other words, an in-plan Roth rollover. You can move your pre-tax assets into that Roth account. Of course, you're going to be taxed on it, but here's the beautiful part. Regardless of how old you are, you will never be subject to the 10% early distribution penalty, because it's waived under law. So in other words, if you really like the Roth and you go, you know what, can I afford to put it for my pre-tax account to the Roth? The answer is it depends. It depends upon what you can afford. So individuals incrementally working with their tax advisors incrementally could convert that to a Roth. Imagine if you're invested in stocks, bonds, and mutual funds, like what you said before, and the stock, bond, and mutual fund goes down in value. That's the best time to convert. In a fortuitous event like a market crash or whatever, there's actually great opportunities. Our consulting lines used to go off, ring off the hook because market's dropping. They're not necessarily getting out of the market. What they're doing is they're doing their Roth conversions, because when the asset goes down, you can move that thing in kind. Even a house. Imagine if your house is worth this much and now it's only worth this much. You're still receiving rent to it. Well, guess what? Move it from the pre-tax to your Roth account. And now all your earnings now are not only growing tax deferred, eventually they'll be distributed tax what? Here's tax free. There you go. That's even better. I hope you don't mind I'm getting excited about this stuff, because knowledge is power.
Yeah.
For your listeners out there, if they don't know the simple concepts, right? You're going to lose out on it.
Yeah. So how do you go from once the asset, like you hit your 65, right? Or wherever you need to start taking distributions out for your Roth. You said it's tax-free forever. So how does it just stay in the Roth account, and then the Roth account just starts paying you distribution? So you're cash flowing from the Roth account, which is tax-free, and then the assets continue to grow inside of the Roth account. Is that how that works?
Well, no, not necessarily. But people who keep their assets in a 401k plan will be subject to the 401k plan rules. Now, when somebody says, for example, they're ready to retire, let's say they decide to retire at 65. I don't plan on retiring at all because I enjoy what I do. All right. Some people are actually starting new jobs here. Say, playing golf is that's too much. Let's do something else, right? So if let's say you work let's say you start another business, because now you've got all this knowledge inside of you. you start another business. Well, guess what? You're a candidate for another individual 401k plan. Or if you really want to just hang it up, well, then roll it into a Roth IRA. Well, guess what? The beautiful part about a Roth IRA, when you reach certain ages, you don't have to do anything. You're not subject to what we call required minimum distributions. So a lot of people that are in their 50s, even 60s, or even 70s, they're saying, you know what, I really don't want to take required minimum distributions. It may be that all I wanted to do is basically save this money so I can hand it to another generation. Or they may say, you know, when I reach 72, how can I get rid of this thing called a required minimum distribution? Well, they're sacrificing it a little bit and then incrementally converting that to a Roth in a 401k plan, eventually roll that into a Roth IRA. And guess what, bro? No more required minimum distributions. When you reach 72, you know what happens? Nothing. How would you like to be able to start taking money out? Not just for yourself, but let's say your grandchild wants to go to college. All right. I don't know if you know this, but you can actually gift up to a certain dollar figure. It's called the annual gift exclusion. And that's where that $16,000 comes in 2022. You can gift to your grandchild and you, the giver, won't get taxed on it. You have 10 grandkids or 10 children, no television. Hey, knock yourself out. Start depleting assets by handing it to another generation and they start gifting. There's no taxation in a Roth. So the message of the story, there's a lot of flexibility. All right. Any assets that have already been taxed under a Roth can be distributed at any time. For example, your contributions, you can distribute contributions at any time, no tax, no penalty. But John Paul, I thought they must have a Roth for 5 years. That only applies to the earnings. We're talking about contributions. Contributions have been taxed already. As long as they're doing good record keeping and tracking all those contributions. Contributions can be distributed at any time, no tax, no penalty. Now ask yourself the question, can I do that? Excuse me, I got choked up. Puberty. Can you do that in a traditional IRA? The answer is, oh heavens, no. But in a Roth, you have more flexibility. Let's say your child, some people are actually using the Roth to save up for education. And you say, what, education? I didn't think you could use that for education. Because keep in mind, contributions can be distributed at any time, right? So some of these grandparents are contributing $2,000 to an education savings account for their grandchild. I said, don't do that because you're going to hurt your grandchild. Why? Because if you want them to go to college, if they even decide to go to college,
right?
If you want to go to college and they don't have enough money, they apply for what we call, FAFSA. In other words, any account that's under the child's name is going to burn them. So some people say, well, what would be what I could do? Well, if you can contribute to a Roth, contribute to your own Roth, because you can take that distribution of the contributions out at any time. What if that child decides not to go to college? Yeah. What do you mean? What if they decide not to go to college and they want to start a business like a podcast? They need equipment for a podcast. I'm just using you guys as an example, right? Well, guess what? You can take that money out and say, hey, honey, I have some seed money for you, because you can take the contributions out at any time, right?
So let me pause you there for a second and break this down. So are you saying that you can, so would you not recommend setting up like a Roth account for your children then?
Well, I didn't say don't set up a Roth account for your children. As a matter of fact, that actually would even be beneficial, especially for specific reasons. There's a lot of parents that are saying, honey, their minor child, right? 14, not the child labor laws, let's say 15, 16, whatever. They say, go get yourself a job, honey, learn the value of $1. You know what that meant? It just meant that child now has what we call earned income, because it's required to make a contribution. So, the moment they have their earned income, the parent is setting up what we call an IRA or a retirement plan on behalf of their child. And most of the time I would recommend it's a Roth. Why is that? Because they don't need the deduction. Right. So from that perspective, the contributions that are being made are based out of the level of the earned income that child has. Imagine if that child comes to you, they're 20 years old now, and they say, you know what, Mom, I really want to buy a house, but I don't have a down payment. Well, wouldn't it be nice to say, actually, you do, sweetie, because I've been contributing to your Roth. Not only the contributions can be distributed, no tax, no penalty, up to $10,000 of the earnings could be distributed out of a Roth. Tax what again? Free. If it's used for first time, there you go. Yeah, I think you're getting the excitement. It can be used for first time home purchase. Imagine forget the education.
Yeah.
Just buy your own house. That will definitely help a lot. Well, depending upon where you live, of course, it may not buy you a whole lot, but at least it's a start, right?
So are you in these like accounts when you're buying real estate and whatnot? Are you having to do like 1031s or whatever? There's no capital gains tax in them, correct?
Well, there's no 1031. So basically, capital gains it's all gone. For example, you buy a $200,000 piece of property. Now it's worth $500,000. You did well. You sell that $500,000. Well, guess what? If it sits in a Roth, there's no taxation. And eventually, the moment you have a Roth for 5 years, and one of the four, remember, death, disability, a payment of 59.5, and up to $10,000 in the earnings, those are going to be distributed tax free. So 1031 really doesn't even have to happen. But you could do a 1031 as long as it's an equal exchange, so that it's not considered what we call a prohibited transaction. You want to buy another piece of property, and you just switch it. Hey, knock yourself out. You can do an exchange as long as the person that you're engaging with is not what we call a disqualified party. Disqualified party means lineal ascendants and lineal descendants. Don't do it with your mom or dad. Don't do it with your grandpa. Don't do it with your grandchildren or great grandchildren or your spouses.
So is there any benefit to doing a 1031 inside of a Roth?
Not really, unless you find a piece of property that somebody is willing to dump in exchange for something else, right? You know, if you know that the asset that you have is going to exponentially grow because of the exchange, hey, knock yourself out. But from a tax benefit perspective, really not a whole lot of benefit. In a traditional, the only problem that I have with the 1031 exchange is that you do get taxed on whatever amount that's in that IRA upon distribution. All right, there's no depreciation under an IRA, so that's why I always venerate towards the Roth if you're going to do anything with real estate, because in the Roth, eventually it's all tax free anyway. It washes everything that you're scared about that's going to happen in the future, because And the thing about a Roth right now is it's available. Imagine if Congress decides to change the rules. I don't think they're going to go back and retroactively tax everybody. They're still elected officials, right? So, but what they will do generally is what we call grandfather those accounts if they do decide to end up getting rid of it, right? But I doubt if they're going to I doubt if they're going to be able to get rid of it, because again, they're elected officials. People have already enjoyed the benefits of a Roth. If somebody, has a suggestion to get rid of the Roth, I don't know if they'll be in office, man. So
there was definitely some articles that were going around that they were mad about some of the politicians who, purchased a bunch of like tech stocks in Roth and just went to like 6 billion or whatever. I mean, obviously those are like, very small cases, but still like,
well, it's actually happening more than you think. Last year, when Richard Neal introduced that piece of legislation, they wanted to introduce required minimum distributions for people who had more than $20 million in their IRAs. And the first amount that they wanted to take out were the Roth assets. Well, guess what? The good news is that legislation
went down,
didn't have any legs at all. But keep in mind, again, when they have written legislation, it could rear its ugly head again, depending upon who's in power, right? So what's the moral of the story? You know what? Accumulate as much as you can on a tax deferred basis. I don't know about you, 100 million is better than no million. So, yeah. Even if you have to take money out and it's not going to be taxed, you still have money in there that's not going to be taxed, right? So the whole ball game is, how do you accumulate wealth?
Right. Interesting. Okay. I want to touch on one more point that you were kind of talking about earlier with the death tax. So what other ways around that are there besides just a Roth or 401k?
Well, the death tax, I don't know if you're familiar with it. The death tax is really the tax on the giver. In other words, the dead person could still be taxed. If you transfer your assets to somebody else besides your spouse, let's first talk about the spouse. A lot of people would leave assets to their spouse. In other words, they name them as what we call primary beneficiary. If you leave assets to each other, there's no tax on that. It's what we call the marital deduction. In other words, you can leave each other as much as you want, and you're not going to get taxed. But if the moment those assets gets left to somebody else besides your spouse, all right, the moment those assets gets left somebody else besides your spouse, if it exceeds a certain dollar figure, which is what we call the unified credit. The reason why they call it unified, because that credit is applicable while you're alive. And also, whatever you don't use up while you're alive gets used up when you die. The good thing about the good thing about our current situation is because with the passage of the Tax Cuts and Jobs Act, the original $5 million amount was doubled to $10 million, which, by the way, it is subject to what we call cost of living adjustments. Right now, we're at $11,700,000. So right now, we don't have to worry about it. But I don't know about you. I don't know when I'm going to die. So depending upon what the rules are when you die, will determine how it's going to get affected. So a lot of people are talking to estate planners. It may be that they would say that, in my IRA, I have 20 million. What the spouse would do is what we call disclaim, as an example. Disclaim up to what we call the annual, unified credit, which means 11,700,000 would go to the kids. No estate taxes, the rest goes to the spouse, and the spouse does the same thing on his or her. The way to mitigate the amount of tax you'll have to pay for estate tax purposes is really to go to a competent estate planner, because it doesn't just address your IRAs and your 401k plans. It also addresses other assets, such as I don't know if you know a lot of people. In my family, a lot of us own more than one homes. So if those are also calculated at current fair market value. So in other words, if you have a lot of assets, you might want to get a competent estate planner involved to determine what best route you need to take. I just gave you some of those examples or strategies that could be taken to reduce or maybe even eliminate some of those risks, such as taking money out and actually gifting it while you're alive. And as long as it doesn't exceed a certain threshold, as an example, currently it's at 16,000. Well, you can dump a boatload of cash. Again, if you have 10 kids, no television, you can dump up $160,000 a year. It may not be as much as what you would like, but at least you can still dump that, And if you're looking for another kid, I'm up for adoption.
No, 100%. And that makes a ton of sense.
Oh, lost your voice.
I said that makes a ton of sense. And I love what you get, the education piece is key, right? Mm-hmm. and that's part of the reason why we have this podcast, is because, we have a strategy called the Deferred Sales Trust. I don't know if you've heard of it or not, but it's a phenomenal estate planning tool.
Exactly.
Because you can sell an asset and move it outside the taxable estate so that they're not subject to that death tax at all. And it eliminates capital gains tax and allows you to reinvest all these different assets.
All of us are Legos, right? We're a part of the big picture. Retirement plan assets constitute typically 42 to 48% of an individual's retirement income source. That's according to the Employee Benefits Research Institute. Your strategy is for assets that are outside these tax deferred accounts. But keep in mind, a lot of people hold assets in a retirement plan and outside of a retirement plan. So really, that's why this is a good marriage for us to do a podcast, because not only can we educate on my field, the tax deferred accounts and retirement plans, couple that up with the assets that they have outside of a retirement plan, and actually hopefully minimize as much taxation that they could have upon death, or even when they're alive, right? Because ultimately, I don't know about you, my philosophy is I work hard for it. Keep your hands off of it, government. I want to be able to hand it to whoever If I want to hand it to Pierce, I should have that. I should have that right.
I love that.
That was just an example. Don't get
I know, but if you're ever that's a good example. So anyways, all right, cool. Well, hey, JP, we're coming up to our time here. Where can people find you?
Okay. Our website is www.theentrustgroup.com. Again, that's www.theentrust, group.com. And they can find not only to establish an account, we have a dedicated section of our website called the Learning Center. The Learning Center not only has information that we've created, but also some retirement experts or retirement vehicle or investment manufacturers that educate individuals on the different types of investments that they have. That includes podcasts, that includes articles, includes an explanation of what a current piece of legislation that may have just gotten passed. And if they wanted to sign up for our newsletter, they can do so, even if they're not a client, because a part of being a client is understanding what you're getting into, right? So if we can help them educate themselves, learn how to fish in regards to this, eventually you're going to make the move, because it's a no-brainer.
Yeah, absolutely. So I love that. And so that's the interestgroup.com, ENTRUST group.com. And you can go find out a ton of information about that.
Yeah. And if they forget the interestgroup.com, just Google my name, John Paul Ruiz. They'll find some of my videos and so on, and they'll be able to find the company name. And of course,
absolutely, and you can connect with him on LinkedIn as well.
Yes.
So all good spaces. Awesome. And if you guys are interested at all in learning more about the Deferred Sales Trust, you can go to capitalgainstaxsolutions.com, and we have a mastermind group every Friday at 10 a.m. Pacific, 1 p.m. Eastern. Where you guys can come, learn, ask questions. JP, I'll be sending you an invite as well, so you can come send people who are interested in that, who have those assets that are not inside those qualified retirement plans, which you guys should definitely set up because they're brilliant. So, and yeah, you guys can find all of that at capitalgainstaxsolutions.com. JP, thanks so much for your time, man. It was a blast. I learned a ton, and sorry for the background noise. We're doing a little office construction right here. So thank you for being patient with us and getting everything going. Any final words?
Well, you know what? Take that step towards grabbing a hold of your assets for the future. All right. And one of the biggest, ways to be able to build wealth again is through retirement plans, as well as, 1031 exchanges outside of a retirement plan. But the key is, as you're listening to this, don't procrastinate. Why is that? Because time is your biggest asset. If you have the time to allow for those assets to grow, do it now.
Awesome. Thanks. And thanks again, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options, not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, qualified Roth IRAs, self-directed IRAs, 401ks, all those good things, is the best way to create, preserve, and grow your wealth, guys. Thanks again for listening. Please rate, review, subscribe, and we'll see you on the next one.